Today, we're going to dig into the really curious case of Vibrant Group Limited. Now, this is a logistics and real estate company, and their latest financials, well, they present a fascinating paradox. It's one of those things that seems to define the basic rules of business, and we are going to unravel it together.
You know, at first glance, Vibrant Group's report for the first half of fiscal year 2026 doesn't look like much. But when you start to really look at the numbers, you see a story that, well, it just doesn't quite add up. It's like a puzzle hidden in plain sight, right there in their income statement.
And that brings us to the central question, right? How on earth can a company's revenue fall, yet its profits just soar? It just seems to defy all logic. I mean, bringing in less money shouldn't mean you have more left over. But that is exactly what happened here with Vibrant Group.
All right, so to solve this thing, we need to dig a lot deeper than just the headlines. The answer isn't sitting there on the surface. It's buried in the line items of their financial statements. So come on, let's follow the money and see what the details really tell us.
Okay, first, let's look at the two sides of this paradox. You've got the top-line revenue and then the bottom-line profit. And in this case, they're telling two very, very different, almost contradictory stories about the company's health.
Let's start at the top. The group's revenue fell by nearly 10%. Now, to put that in perspective, that's a drop from about $78.7 million down to $71 million. That's a pretty significant dip, no matter how you slice it.
But here's the wild part. While that revenue was down, their bottom-line profit jumped by an incredible 34.9%. It grew from $4.5 million to over $6.1 million. So seriously, how did they manage to do that? How do you increase profits so dramatically with less cash coming in the door?
This brings us right to the heart of it all. And the answer isn't some single silver bullet. It's actually a series of really smart, really disciplined financial moves. The key to this entire puzzle is one thing: masterful cost control.
Okay, this table here gives us our first major clues. You can see revenue went down, right? And gross profit, that's what's left after the direct costs of their services, that went down too. But look further down that statement. See the finance costs? They dropped by over 21%. That's a huge saving that flows directly to the bottom line.
And this chart really just drives that point home. By cutting down their interest expenses on bank borrowings and leases, Vibrant Group saved nearly $1 million in just 6 months. That saving alone did a ton of heavy lifting to offset the lower revenue. It's a really powerful example of financial discipline at work.
But it wasn't just that one thing. You can see here they had a whole strategy for cutting costs. They trimmed their administrative expenses, things like legal and professional fees, by almost 5%. They slashed those finance costs we just saw. And then their income tax bill was over 25% lower. And on top of all that, a little accounting adjustment, a reversal of a prior loss, added another $700,000 back to their profits.
So we know how they boosted their profit. It was all about those cost savings. But now, to understand why the revenue fell in the first place, we got to look at how Vibrant Group is structured. They operate in 3 really different segments, and their performance was, well, it was all over the place. This is where the story gets a bit more nuanced.
This chart shows you exactly where the company's money comes from. A staggering, and I mean staggering, almost 95% of their revenue comes from the freight and logistics segment. It completely dwarfs the real estate and financial services divisions. So it's pretty clear. As goes freight and logistics, so goes Vibrant Group.
And the report confirms it. The huge freight and logistics segment saw its revenue fall because of, and I quote, weaker business activity and softer demand. Their real estate arm, which manages industrial properties, also saw a decline. But what's interesting is their tiny financial services division actually grew its profit. But it was just way too small to really move the needle for the whole company. So this clearly points to the source of the revenue problem. It's right in their main line of business.
Okay, so they managed their internal costs brilliantly to deal with the slump in their biggest business. But what's next? Can this kind of discipline keep working against all these external pressures? Well, the company's own outlook is, let's just say, notably cautious.
This quote from their report is pretty direct. They're basically warning investors that it's a tough, unpredictable world out there for their core logistics business. They're pointing directly at things like geopolitical tensions and shipping route problems as immediate threats to their operations.
And they're not being vague either. They're very specific about the headwinds they're facing. What you're seeing here are the major risks they see coming over the next year: ongoing supply chain chaos, volatile markets, and unpredictable customer demand. All of that stuff could really hurt their pricing and their margins. This is the reality they're up against.
So what's the big takeaway here? I think it's that Vibrant Group has shown this remarkable ability to control what it can. It was faced with falling sales in its main business, and what did it do? It meticulously managed its internal expenses, from financing to admin costs, to not just protect, but to dramatically grow its profits.
And that leaves us with one final, really crucial question. Their internal discipline? It's proven. But the biggest challenges they face are all external: global trade, geopolitics, market volatility. So can their internal financial strength continue to overcome the external challenges of a global market they simply cannot control? Well, only time will tell if they can keep navigating these choppy waters so profitably.